Let me start with a couple of questions to our wonderful audience. How many people here work in agriculture? No one? Right. How many people work in manufacturing? You suppose? How many people work in financial services, law, accounting, consulting of any type? This is obviously not surprising. Okay? UK has one of the highest percentages of people employed in financial and business services in the world. In fact, the highest of major economies. Financial and business services, or shortly FABS, not to be confused with fabulous. Why am I going to talk about them? They're very important. They make a very diverse sector, but one which, with different parts, very strongly connected to each other. Yeah? So when you think about major transactions, for example, companies buying other companies or raising billions of funds, these deals involve lawyers, accountants, consultants, in addition to bankers. This is why we should talk about the financial and business services complex. UK also has arguably the most competitive financial and business services industry in the world. It is by far the largest net exporter of these services in the world. Being crucial to the British economy, financial and business services are key to the global economy in general. They epitomize globalization, including some of the most internationalized companies in the world. Think of PricewaterhouseCoopers, JP Morgan, think of McKinsey. They help other companies globalize. They are key agents of financialisation. They help companies, governments, households raise funds. They provide them with financial expertise. They're crucial to urban development. They concentrate in cities and they connect cities through flows of money, professionals, and information. Time now is absolutely brilliant to study FABs. Why? Some of them are accused of perpetrating the global financial crisis and facing a wave of new regulation which transforms the sector. China and the Global South are developing their own financial and business services sector, with cities like Shanghai, Dubai, and others aspiring to challenge New York and London as financial centers. And digital technologies, mobile banking, robo-advisors, and many others challenge the very business model of these services, replacing labor with capital-intensive technologies. Again, promising or threatening a transformation of the sector. So in this context, the question I'm interested in, how are these forces changing the map of financial and business services as a crucial part of the financial map or map of the financial world, and with what impacts on economic development of cities, regions, countries, and globally. So this is the way I phrase the question about the map of the financial world and how it's changing. You would think this question has been answered many times before, but it hasn't. Okay? Research on finance is obsessed with focus on markets, prices, and countries as units of analysis, with very little attention to issues of development, extremely little attention paid to cities or regions, hardly any to inequality. Offshore finance tax havens, though you read about those in media every day, hardly ever mentioned in academic research on finance, especially in mainstream research on finance in economics. So mainstream financial research has little to offer about these things, okay? Financial centers, development, inequality, debates on tax evasion and avoidance, it's all about preoccupation, short-sighted preoccupation with markets, prices, volumes. Given the neglect of geography in mainstream financial research, I think we need a new comprehensive framework to place finance in geography and geography firmly in finance. And the concept that I'm developing in my recent research is the concept of global financial networks. These are networks of financial and business services, financial centers, and offshore jurisdictions. FABS are the master weavers of these networks. Okay? Their command and control functions concentrate in financial centers which offer large and deep labor markets, infrastructure, proximity to key customers. Financial assets, instruments, are mostly traded in and out of these financial centers. Financial assets, however, as well as non-financial assets, are often booked away from where these assets originate, where they controlled and traded. They often booked and registered in offshore jurisdictions. Okay? And I call them jurisdictions and not tax havens because they're not just about tax. They're about taxation, regulation, and secrecy. Global financial networks are at the heart of the world economy. As intermediaries, they influence relationships among governments, among businesses, among households, but also between governments, households, and businesses. Through pricing financial assets, valuing things all over the world, setting exchange rates, influencing exchange rates. They influence these relationships. They influence the very way we think about the map of the world economy. If you think about concepts like emerging markets, BRICS, shareholder value, value at risks, fundamental concepts in understanding business and finance. These have been coined and popularized by financial and business services. BRICS concept comes from Goldman Sachs, emerging markets popularized by Morgan Stanley, value at risk, JP Morgan, and so on and so forth. So when a wealthy household or individual or a company looks to minimize taxation or regulatory costs, they're not going to go to shop around Pacific Islands or Caribbean islands. Okay? They go to a financial and business services firm in a financial center to be presented with a menu of offshore jurisdictions and services they can offer. This idea, this concept builds on a long tradition in economic geography, urban studies, political economy, but I will not bore you with theory. Methodologically, you can try to model these networks as complex systems. Complex because competition interactions in global financial networks take place at many different scales and levels. It's competition between firms, competition between alliances, groups of firms, between cities, regions, countries, alliances of countries. Yeah? You can model them this way, and this is one of my objectives for future research. Yeah? For this lecture, however, my plan is to illustrate the building blocks of this concept with examples, maps, diagrams, with focus on what has changed, particularly since the global financial crisis, since 2008. So I'll start with financial and business services and the structure. Then I'll talk about financial centers and offshore jurisdictions. Then I'll be putting this together, thinking about global financial networks in relations to businesses and governments. And finally, talk about impacts on uneven development. Okay? FABS, as I said, are globalized, they networked, but they also very hierarchical, which is an aspect of the structure which gets relatively little attention. So at the top of the sector sits the elite of securities industry. This industry invents, produces, distributes, circulates securities like equities, bonds, financial instruments used to help or used by governments, by private companies to raise funds. Fees, salaries, bonuses are much bigger in securities industry than in other financial and business services. Okay? But within the securities industry, we can distinguish between two important parts. On one side, we have investment banking. Okay? Securities firms that work more on the sell side of the industry, mostly with those who sell securities, like big corporations, helping them to raise funds. Okay? On the other side, we have asset management. Asset managers work mainly with those buying securities, managing investments. Okay? Managing investments of pension funds with contributions from you and me, managing money, wealthy individuals, companies, and others. Again, fees, salaries, bonuses, much bigger, and this is not, by the way, advice to students, much bigger in investment banking than in asset management. Investment banking is a center of power at the peak of this industry. Well, to illustrate this, let me ask you to imagine a world in which some of the most important economic decisions about how much capital should cost, what exchange rates should be, who should capital be made available for and where. Imagine a world in which these decisions are in the hands of 20-something-year-olds, mostly men, who never managed any money of their own or any business. The problem with this thought exercise is that it's real. Okay? This is what investment banking is about. Okay? This is what led me to coin this phrase, investment bank capitalism. Okay? Can also be illustrated with the quote from Financial Times coming from late 2008. And this was a reaction to the news that one of the leading investment banks, Goldman Sachs, was saved from doom by a huge injection of capital from Warren Buffett, one of the world's richest investors, and a bailout by the US government. Financial Times wrote, I had to read it many times when I got the newspaper. A lot of people used to think that Goldman Sachs ran the US economy. Now we know it does. This is hugely exaggerated. But there's a grain of truth which is really deserves attention. This is why I coined this phrase, investment bank capitalism. Securities industry has enjoyed great times, at least since late 70s. So in the US, annual pay per person outside of the financial industry grew by exactly zero, okay, in real terms. In securities industry, it more than doubled. And it grew much faster than in any other part of the financial sector. Internationally, securities industry grew in terms of employment much faster than the rest of finance, ordinary banking or insurance. This again made me think that a lot of arguments about financialization of the world economy, growing significance of finance in the world in recent decades, could be made actually more precise if you referred to this phenomenon as securitization, as growing significance of the securities industry. Yeah? A lot of things that happen in insurance, in ordinary retail banking, not glamorous at all. Okay? I mentioned that because since 2008, there are signs of rebalancing at the top of the FABS hierarchy. Investment banks find themselves under a lot of pressure. Yeah, they associate it with the roots of the financial crisis. Every now and again you see media reports about investment banks charged with fraud, other kinds of wrongdoings, manipulation of interest rates, manipulation of foreign exchange rates. paying fines in billions of dollars that accumulate to hundreds of billions of dollars now that the industry has paid. Asset management, none of these problems. You're more likely to see smiling faces of asset managers like the CEO of BlackRock, the world's largest asset management company, managing nearly $5 trillion and growing every day. Data confirms this sense of shifting power and significance away from investment banking towards asset management. So between 2008 and 2013, asset management industry surpassed investment banking in terms of payroll and in terms of employment, at least in the US. What's the geography of investment banking and asset managers, and how has it changed? How has it changed in terms of the nationality of institutions involved? When we look at investment banks, nearly 50% of investment banking fees are earned by US banks. Okay? Second comes the UK, despite all the cries about the downfall of British banking. It was actually Switzerland that took the biggest hit after the crisis. Okay? In assets under management, in asset management business, we also see a striking level of concentration. Yeah? US firms manage over 50% of all assets managed in the industry globally. Again, UK comes second. Financial centers, the next building block. Here I have to start with this expectation that financial centers in Asia are rising. There is hype, especially about Shanghai challenging London and New York soon as a global financial center. Okay? Global Financial Center Index, the most influential index that ranks cities according to their competitiveness as financial centers. In their top 25 list includes 12 cities in Asia. But hold on a moment and look at the actual value of transactions conducted in these and out of these cities. Okay? This is the data that we collected for investment banking, asset management, and foreign exchange trading, currency trading. Asia Pacific. So if you add to all of Asia, actually Australia and New Zealand as well, accounts for a surprisingly small share of these high financial activities. Less than 10% of investment banking, less than 5% of asset management, less than 20% of forex trading. And these shares, despite expectations, are not rising. For asset management and forex trading, they actually declined since 2008. If we look at actual transactions in cities, focus, for example, on cross-border fees from capital market transactions, this is what the top 25 would look like, which I put together with my colleagues. It would include only 4 Asian cities, Tokyo, Hong Kong, Singapore, and Beijing. Shanghai doesn't even make it into the top 25. Is behind Beijing in addition to Hong Kong. This is what the map would look like, here illustrating both cross-border fees in investment banking and domestic fees. And again, you see the relative insignificance of cities and centers in Asia. We have very detailed data on these transactions, which allows us to really robustly and econometrically ask the question, what turns cities into international financial centers? Okay? What factors correlate with the size and growth as international financial centers? There are 4 groups of key factors. First, political and legal institutions, especially strong rule of law and enforcement of contracts. This is what financial and business services like most about political and legal environment. Large, flexible, and open labor market. All of these very important features of a labor market for a city to be a thriving financial center. The city has to be a leader in domestic finance before it becomes a major international financial center. You cannot jump through this. You cannot establish yourself as an international center overnight without being a domestic center first. So there is an evolutionary path to go through. Also, the city needs large, internationally expansive, non-financial firms in the city. Finance cannot feed on itself. Even in the city in which it operates, it needs a healthy, real economy, non-financial sector. Equally interesting may be factors that turn out insignificant in the analysis. It doesn't seem to matter whether English is the official language of the country in which the city is located, whether the country has English common law in contrast to civil law. If the law ensures rule of law, if it ensures enforcement of contracts, doesn't matter where it comes from, whether it was established by the British, the French, whoever else. Doesn't seem to matter whether you are in the Greenwich Mean Time Zone or not. Even corporate taxes don't seem to matter, maybe because financial firms are very skilled at bypassing them anyway. What matters, though, hugely, is membership of the European Union. This is something that really we found really interesting and important. Okay? A city that is in the European Union has 5 times bigger chances to be a major international financial center than a city with the same characteristics but outside of the European Union. And I dedicate this finding to Boris Johnson. Offshore jurisdictions are tricky to research by their very nature, secrecy. We focused with my colleagues on foreign direct investment. Foreign direct investment is about private companies investing abroad, either setting up businesses from scratch abroad or buying existing businesses in foreign countries. And the network looks intriguing. So UK's stock of outward FDI, so money invested by British companies abroad, is nearly as big as that for the US. The Netherlands comes third, Luxembourg comes fourth. So what this means is that Luxembourg companies invest abroad nearly as much as German and Japanese companies put together. Does it make sense? Well, it only makes sense if you understand that Luxembourg and the Netherlands operate as leading offshore jurisdictions. Investment passes through them. It's registered, booked there, comes in and goes out, and is booked there for reasons to do with taxation, regulation, and secrecy. Investment doesn't originate from these countries. We subjected this data to principal component analysis, which allowed us to identify families of offshore financial connections or sub-networks of this global network of offshore finance. What we get can be mapped, and it's really a footprint of political and economic geography. So if you start in the middle, you get this cluster of countries with Mauritius as the primary offshore jurisdiction, India and some African countries as major sources of offshore investment that use Mauritius. Okay? We dub it British Empire because it seems to be the footprint of, mainly involves countries that were parts of the empire. The second region covers the Americas and Japan, with leading offshore jurisdictions in British Virgin Islands, Cayman Islands, Bermuda, Panama. Seems to reflect the sphere of American influence. There are 2 more regions which are younger. One is the Eastern Bloc, with post-Soviet countries in the center, and Cyprus as the major offshore jurisdiction. This is the offshore jurisdiction of choice for Russian investment. And finally, we have a very big influential Greater China region, lubricated with Chinese offshore financial flows going through Singapore and Hong Kong as the leading offshore jurisdictions. These regions are connected into a global network. Who they connected by? They're connected to a large extent by current or former British colonies. So it's true when people say that offshore financial world is to a large extent the creation of the British Empire. Some people call it the second British Empire. We wouldn't have it, at least the way it operates, without the history of British Empire. But even more important are OECD members as connectors in these networks. This may be surprising because it's OECD, the rich countries club, that led initiatives against harmful tax competition, against money laundering since the 90s. So what has happened? We think what has happened is these initiatives have been targeted at or against relatively weak offshore jurisdictions, Pacific Islands, Caribbean islands, which left offshore finance in the heart of OECD with the economies of Switzerland, Luxembourg, and Netherlands relatively undisturbed and thriving. Very hypocritical of OECD. China's position is probably most intriguing. I'm not surprised to see that a lot of Chinese investment is made through Hong Kong, that a lot of investment money leaves China and then comes back to China. This is how Chinese capital expresses limited trust in the Chinese government, and who would blame them? But what is interesting is what links these companies. So what do they have in common? Any answers? They all state-owned Chinese companies. They're actually 7 largest national champions. These are the biggest state-owned companies in China that are supposed to go out and challenge Western companies. But they have something else in common. They all have subsidiaries in British Virgin Islands, Cayman Islands, or both. And why would require another lecture. I'm still looking for an answer in China and elsewhere. What about relationships between businesses and governments and global financial networks? Here, we're inspired by a Swiss piece of research which investigated the global corporate control network for 2007. So they took data on over 43,000 companies in the world, all companies operating in more than one country, and they collected data on the ownership, direct and indirect ownership and control in these companies. And what they found out was that nearly 40% of the value of all these companies in the world was controlled by a group of only 140 plus companies in the super core of the global corporate control network. And the largest, the most influential of these are illustrated here as this ball of wool. Ball of wool because these companies have a lot of cross-holdings with each other. Nobody controls them, at least not in the corporate world. They control each other, and they control 40% of the value of the whole corporate world. And who are they? Mainly investment banks. Some of them don't exist anymore, like Lehman Brothers. A few asset management companies, insurance companies. Not a single company from outside of North America or Western Europe. But that's 2007. So what we wanted to do was to replicate this study economically, though, with as little data as could be justified for this kind of study. So we focused on all companies with sales over $50 billion in 2014. There are 208 companies like that. And we looked at their shareholding structures, at their ownership structures, both directly and indirectly. Okay? Because you can be an owner in an owner, which means you have some indirect influence on firm A or B. What we're interested in is the economic footprint of shareholders, whether they're companies, whether they're governments, whoever they are, families, individuals. So the direct footprint would be the sales, the revenues of firms in which you have owned big stakes directly. Indirect footprint would be the value of sales of companies in which you hold control indirectly. So if you follow this procedure and prepare a list of 20 largest world investors in 2014. This is the ranking you get. Populated mostly by asset managers, not investment banks anymore. There is JP Morgan here, Mitsubishi, Japanese bank that works with Morgan Stanley, but mainly asset managers, several governments, national governments, a few wealthy families. In the super core of these 20 top world investors, there are a lot of connections. They're strongly connected with each other, just as the Swiss research showed in 2007. By far, the two leading, the master weavers of these networks are BlackRock and Vanguard. This is the largest and the second largest asset management company in the world, with by far the largest direct footprint in the global corporate control network. The footprint of Vanguard is much more US-centered. BlackRock is much more international, particularly prominent in the UK, actually, because BlackRock took over in other asset managers, Barclays Global Investors in 2009. But we also find among the top owners of the corporate world 4 national governments. Norwegian, built on accumulated revenues from oil and gas exports in a sovereign wealth fund where they accumulate these proceeds and invest them in other companies. Chinese government working through their wealth funds using foreign exchange reserves. Japanese government, which controls one of the world's largest pension funds, pension fund for public sector employees. Qatari government using, again, gas, mainly gas revenues in a huge wealth fund. And if you think that foreign state control is something that does not affect British economy too much, think again. Actually, the world's largest corporations with a significant foreign state ownership is BP. And this happens through an ownership connection they have with a Russian state oil company, Rosneft. Standard Chartered, a British bank, their major owner is an investment fund in Singapore, Temasek. For Barclays, it is Qatari government, a holding controlled by the Qatari government. The last building blocks, or the last aspect I want to talk about of global financial networks is the development question. I want to focus on the global level and then at subnational level with 2 simple illustrations. At the global level, I'm interested in the share of New York and London, the world's leading financial centers, their share in global financial transactions. And by which I mean not business that is conducted by companies that are headquartered in the cities. I mean really business conducted in these cities, whether it's by US or British companies or any other companies in the world. So the share of New York and London in investment banking fees, nearly 50%. In assets under management, nearly 30%. In foreign exchange trading, 60%. And actually, for assets under management and foreign exchange trade, increasing concentration. This is the power of the nylon axis in global finance. At subnational level, let's look at the financial center hierarchy and regional economy, comparing Germany and the UK. So in Germany, regional financial centers are smaller than Frankfurt, but still comparable in size. In the UK, obviously, London dwarfs regional centers in terms of employment. But what's happened since 2008? Not much in Germany. Employment and hierarchy of financial centers in Germany have been quite stable. You cannot tell the difference between these lines. In the UK, complete contrast. London, more than recovered in terms of employment in finance by 2012. Regional financial centers, cities like Birmingham, Manchester, shed 10% of jobs by 2012. It's about 40,000 well-paid jobs. In the rest of the UK, when you move to even smaller towns and cities, they kept losing jobs until 2012, and the recent data shows that decline has continued. So the British financial landscape has become more and more polarized. Why? One reason is forced consolidation of financial institutions, with the example of Lloyds, London headquartered, taking over HBOS, Edinburgh-based bank. Another reason is actually new regulation, perverse impact of new regulation, which creates a lot of jobs in compliance, but these jobs tend to concentrate in London again, at headquarters. The same is happening in Germany. But in Germany, the counterweight to the centralization concentration tendencies is the strength of regional and local banking, including cooperative banking, which this country doesn't have. And at least this protected German regional center and local centers and local finance from the scenario that took place in Britain. Well, I've probably bombarded you enough with detail. Maps, graphs, diagrams. So it's time, in the next 5 minutes or so, to try to put it together and into some kind of a big picture. It's all work in progress, so it's not easy. They're all preliminary conclusions. So what does the new map of financial world look like? What are the trends on this map? One is growing concentration of financial activity and power. Okay? Despite all the expectations with a more development of a more pluralistic, multipolar financial world, the opposite seems to be happening. At the global level, with growing concentration in New York and in London, in asset management, investment banking, key financial industries. Also at subnational level, in the UK, I'm sure the UK scenario has played out in many other countries. It didn't in Germany, though, so it's not inevitable. Institutionally, in terms of the institutional structure of the financial world, we see an important shift away from the stronghold of investment banking towards more power for asset managers, institutional investors, and state capital as well, governments as big players on financial markets. This is important because it may imply a shift from what is important to investment banks in finance, which is liquidity, quick investment, quick money and exit, trading, to what is important, more important to asset managers and state capital, which is control, strategic relationships, long-term relationships, for better or worse. These trends seem to be enhanced by new regulation, somewhat perversely, and technology. New regulation creating a lot of compliance jobs. It mostly reinforces incumbent institutions, incumbent centers of financial activity and power. And technology makes processing ever larger amounts of and volumes of transactions more cheaply, which again means that companies like BlackRock can develop there are no limits to the scale they can reach. And one day we wake up and they own 5 to 10% of every company in the world. And what are they then? Some kind of global financial government? Yeah, there are big questions in terms of monopoly power. Okay? Is it a utility company then, or is it still a private financial company that actually competes internationally? And despite all expectations, challenge from China and the global south has been very muted. This is what people expected. The financial crisis brewed in New York and London. It came from the American economy through the London to the European economy, but it actually didn't really raise the profile of Asian finance and the Global South in general match. There is not a single Chinese or financial institutions from the Global South that can challenge the power of leading Western investment banks, asset managers, or other financial institutions and business services firms. Why this matters? It's about uneven development. Money doesn't flow to where it's most needed, despite some crazy theories in financial economics that claim that it does. It's sticky. It sticks to centers of power, to financial centers. Proximity is important. The more concentrated financial landscape we have, the more uneven access to capital we have. There are geographical risks. Already 60% of forex trading is concentrated in the city of London and in New York. And what if something happens, some disaster strikes both cities at the same time? Yeah. Horrible, hopefully unrealistic scenario. But then there is no forex market. What kind of exchange rates will we have tomorrow? There is an issue of resilience here with which concentration poses as well. This leads to the issue of financial stability. One of the biggest problems that we believe led to the global financial crisis was the too big to fail problem, that we had gigantic financial institutions, commercial banks, investment banks, that were everywhere with trillions of dollars or pounds on their balance sheets that just couldn't fail. And they knew that. They took advantage. They behaved irresponsibly. And we bailed them out. Have we dealt with this problem by now? No. Unfortunately, these maps and analysis show we haven't. Actually, these maps may indicate we're adding a new problem to the too big to fail problem, which is too interconnected through increasing connections in the offshore financial world, through increasing interconnections in the global corporate control network. Which means that the chain reaction, the risk of chain reaction in the financial system is increasing. And I think there's also an issue of cognitive capture. After all, finance is about setting prices around the world, affecting relationships between countries through exchange rates. Okay? It's about valuing, to some extent, the world around us. However, we may disagree with the valuation that they impose. Okay? So we want these values to represent as wide an array of worldviews as possible. And if we're facing centralization of power and concentration, it means they represent narrower views, however cosmopolitan these institutions may consider themselves, and these cities in the lead, including London. That's a lot of work, and as I said, it's all in progress. In my research, I'm planning to develop the concept of global financial networks, do some more practical things like we're launching now with colleagues a global network on financial geography, have 300 people on our email list. We want to publish the first atlas on, there is no atlas on finance anywhere. Can you imagine? There are atlases on anything, sexual behavior of penguins. I have one. No atlas of finance. And we're planning to launch, hopefully, a new journal. It's a lot of work. I'm an optimist. Some encouragement comes from the media. Last year, John Others from Financial Times, in a column featuring my research with Duncan MacDonald-Korf, who's also based here in the school, wrote, investors have much to learn from academics, and certainly not just from economists. Now it is the turn of geographers. Let's prove him right. Thank you.